Jack Bogle, the father of index funds, is famous for saying, "Simplicity is the master key to financial success." And there is no simpler and effective investment portfolio than the three-fund portfolio. By owning just three simple low-cost index funds, a total US equity, a total US bond, and a total international equity, all of us can outperform the vast majority of mutual funds out there. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. Today, I'm going to walk you through step by step on building your own three-fund portfolio. All right, let's start with step one. The first step to building our three-fund portfolio is to gather our ingredients. And in this case, it will be our three low-cost index funds. One to represent the US equities market, one to represent the bond market, and one to represent the international equities market. As regards to the US equities market, my personal favorite is the Vanguard Total Stock Market Index Fund, also known as VTSAX. Introduced in 1992, this one fund allows investors to own more than 4,000 publicly traded US companies at an extremely low cost. VTSAX tracks the CRSP US Total Market Index. CRSP stands for Center for Research and Security Prices and is part of University of Chicago Booth School of Business. It is probably the most comprehensive total market index that includes around 4,000 companies across mega, large, small, and micro capitalization. There is a minimum investment of $3,000 and an expense ratio of 0.04%. Putting this in dollars means that an investor can invest $10,000 into VTSAX at a cost of only $4 per year. An alternate equities fund you can also hold is Vanguard 500 Index Fund, also known as VFIAX. While VTSAX owns every US company out there, the Vanguard 500 holds only the 500 largest publicly traded companies. The difference of 3,500 companies may sound like a lot, but in actuality, VTSAX and VFIAX are actually a lot more similar than different. And this is due to market capitalization. Market capitalization refers to the total dollar market value of a company. Its size is based on the number of shares and the current market price of each share. Oftentimes, bigger the company, bigger its market capitalization. At the time of this video, the biggest companies in the United States based on market cap are Apple, Microsoft, and Amazon. Therefore, the 500 largest publicly traded companies, given their sheer size, represent 80 to 85% of the market. So if you prefer to hold the largest companies as your core equities holding, VFIX is a great alternative to VTSAX. The second fund you want to hold in your three-fund portfolio is one to represent the bond market. And my favorite in this category is the Vanguard Total Bond Market Index Fund, also known as VBTLX. This one fund allows investors to own more than 10,000 very diversified, high-quality US investment-grade bonds. The VBTLX tracks the Bloomberg US Aggregate Float Adjusted Index, a broad-based benchmark that measures the investment grade's US dollar-denominated fixed-rate taxable bond market. In simplest terms, this one fund is designed to provide broad exposure to the US investment-grade bond market. There is a minimum investment of $3,000 and an expense ratio of 0.05%. Putting this in dollars means that an investor can invest $10,000 into VBTLX at a cost of only $5 per year. The third fund you want to hold in your three-fund portfolio is one to represent the international market. And my favorite in this category is Vanguard Total International Stock Index Fund, also known as VTIAX. This one fund offers investors a low-cost way to gain equities exposure to both developed and emerging international companies. It holds more than 6,000 international stocks from developed countries like England and France, as well as from emerging countries like China and Brazil. It includes major international companies like Taiwan Semiconductor Manufacturing, Nestle, and Samsung. The fund tracks stock markets all over the globe, with the exception of the United States, following the FTSE Global All Cap excluding US Index. There's a minimum investment of $3,000 and an expense ratio of 0.11%. Putting this in dollars means that an investor can invest $10,000 into VTIAX at a cost of only $11 per year. So to summarize, if your investment firm is Vanguard, consider the following three funds for your three-fund portfolio: the Vanguard Total Stock Market Index Fund, VTSAX, the Vanguard Total Bond Market Index Fund, VBTLX, and the Vanguard Total International Stock Index Fund, VTIAX. Before I move on to step 2, I do want to share some alternate options, specifically if your preferred investment firm is Fidelity. To represent your equities holding, I would recommend the Fidelity Zero Total Market Index Fund, also known as FZROX. The fund tracks Fidelity's in-house Fidelity US Total Investment Market Index, and it represents approximately 2,600 US-based companies. Compared to VTSAX, it excludes certain companies based on market capitalization, essentially smaller companies. However, I wouldn't concern myself too much about this difference, given when looking at it from a perspective of market cap, the excluded companies represent less than 1% of the total fund. Similar to VTSAX, the top holdings in this fund are Apple, Microsoft, and Amazon. The nice thing about FZROX is that it has an expense ratio of 0%. Yes, you heard me right. $0 to invest in Fidelity Zero Total Market Index Fund. Thus, a zero in its name. But a quick thing to note about Fidelity Zero Total Market Index Fund is the fact that you can transfer your shares of FZROX to another firm without selling your holding. And when you sell your holdings, you have to pay taxes on your capital gains. The Fidelity Zero Total Market Index Fund was designed with 0% in order to gain more customers. So Fidelity doesn't want you to move your money to a different firm, and this limitation creates that barrier. If this limitation concerns you, you might want to consider looking at Fidelity Total Market Index Fund, FSKAX. It has an expense ratio of 0.015%, but it does provide more flexibility than the FZROX. Moving on, to represent your bond fund, I would recommend Fidelity US Bond Index Fund, also known as FXNAX. It tracks the Bloomberg Barclays US Aggregate Bond Index, which is composed of investment-grade government bonds, corporate bonds, and mortgage-backed securities. It holds approximately 8,400 bonds. The top issuers are US Treasury or issuers of mortgage-backed securities like Fannie Mae and Freddie Mac. It has an expense ratio of 0.025%, which means if you have $10,000 invested in Fidelity US Bond Index Fund, you're essentially paying $2.50 from Fidelity to manage this fund for you. To represent your international fund, I would recommend Fidelity Total International Index Fund, FTIHX. The fund tracks the MSCI All-Country World Index, including the United States. It represents approximately 5,000 international companies from both developed and emerging markets. The top holdings in this fund are made up of companies like Taiwan Semiconductor, Nestle, and ASML Holding. It has an expense ratio of 0.06%, which means if you have $10,000 invested in FTIHX, you're essentially paying $6 for Fidelity to manage this fund for you. Alright, now that you have your core ingredients, your index funds, let's talk about asset allocation, which is step 2 to building your 3-fund portfolio. In this step, we want to identify how much of each fund we want in our portfolio. After identifying your specific index funds, I would actually say this is the most important investment decision. I say this because with the exception of the amount you are saving and investing, your asset allocation, your stock to bond ratio, determines your expected risk and therefore your expected long-term returns. It's very important to understand that risk and return go hand in hand. The higher the expected return, the higher the expected risk. If we want greater returns in our portfolio, we must get comfortable with greater risk. And our stock to bond allocation is the mechanism to control that risk level. Vanguard research shows the average annual return and the worst single-year return of various stock to bond allocation from 1926 to 2021. Let's say that we went 100% in stocks, assuming the most risky asset allocation that we can. The average annual return will be 12.3%. But in our worst year, we would have lost 43.1% of our portfolio. This means that if we had a $100,000 portfolio, in a single year, we could see our portfolio lose up to $43,000 in value. This could be hard to swallow for many people, especially if you're expecting to pull some of that money out soon. So let's say we decided to go 100% bonds, assuming the least risky asset allocation that we can. In our worst year, we would have only lost 8.1% of our portfolio, which is much better than the 43% from our 100% stock portfolio. However, our average annual return is only 6.3%. Half of what we would have gotten compared to a 100% stock portfolio. We took less risk going with 100% bonds, but we also got less returns. The reality is that most of us probably fall somewhere in between. So we must find our ideal asset allocation that aligns with our risk tolerance. We may not be so risky that we go 100% in stocks at all times, but we also might not be so risk averse to have all of our money in 100% bonds. There's a lot that you want to consider in determining your risk tolerance, such as your current income, when you plan to retire, and your financial goals. We won't have time to dive into all of them in this video, but if you'd like to spend the time to determine your own personal risk tolerance, check out my video here. For now, to help you identify your starting place, let me share with you a few examples. If you're aggressive with your risk tolerance, meaning you actually embrace volatility and have a long-term horizon for your investment, a 90 to 10% stock to bond ratio might be okay for you. You might even be able to push it to 100% in stocks if you really want to be aggressive. And if you're in your 20s or even 30s, I would actually recommend this given you have time on your side. When you're young, risk is your friend. Don't shy away from it. Market will always have its ups and downs, but if you have time on your side, most often your portfolio will fully recover within a few years. Now, let's say that you're more moderate with your risk tolerance, meaning you're okay with volatility, but because you have a large family or your income isn't as consistent, you don't want to be so risky. Here, a 80 to 20 or a 70 to 30 stock to bond ratio might be the best. You have enough stocks to take advantage of the market, but also enough bonds to smooth out the ride. If you're in your 40s or 50s, you might be in this bucket. All right, let's say that you're conservative with your risk tolerance. You're in the later stages of life, so retirement is right around the corner for you. And you don't need to become ultra rich in your lifetime. You have your lifestyle and you just need the ability to fund it. In this case, a 60-40 or even a 40-60 stock to bond ratio might be a good option. You can taper your bond up or down based on how conservative you are. One thing I want to call out is that in these examples, we don't talk about international stocks. How much of our stocks we should allocate to Vanguard Total International Stock Index Fund or Fidelity Total International Index Fund. I know the examples here don't specifically call out the percentage of stock allocation that should be invested in international stocks. And to be honest, this is one of the most controversial subjects in investing. There are constant arguments for more international funds versus less international funds. And both sides of the argument actually make sense. We don't have time to delve into all the details of the argument in this video, so if you'd like to learn more, check out my video here. But let me at least share with you my personal recommendation and what I do. My personal recommendation is that around 20% should be fine for most investors. Jack Bogle suggests up to 20%, and Vanguard studies recommend minimum 20%. So in general, 20% of your stock allocation in international stocks is a good compromise. So this is how it will look in an 80-20 stock to bond asset allocation. 60% in Vanguard Total Stock Market Index Fund, VTSAX. 20% in Vanguard Total International Stock Index Fund, VTIAX. And 20% in Vanguard Total Bond Market Index Fund, VVTLX. And know that asset allocation is a fluid concept. As your life situation changes, so should your asset allocation to align with your new risk tolerance. All right, let's move on to step 3, optimizing taxes. So far, we've identified specific index funds and the appropriate asset allocation. However, in order to optimize our investments, in this case meaning minimizing tax treatment, we must also determine where to hold our investments. This is essentially understanding which investments goes in what accounts. And when I'm talking about accounts, I'm referring to buckets that hold the specific index fund investments. Commonly known accounts like the 401k, IRA, and taxable brokerage accounts. In general, there are two types of accounts that we should be aware of: tax advantage accounts and ordinary accounts. Tax advantage accounts are commonly known in retirement vehicles such as 401k, Roth IRA, and traditional IRA. In the United States, the government taxes dividends, interest, and capital gains on our investments. However, it has also created several tax advantage accounts to encourage retirement savings. Thus, when we hold money in these accounts, the IRS, the Internal Revenue Service, gives us tax benefits in forms of tax deferment or tax-free withdrawals depending on the type of account. A general rule of thumb is that no matter what financial situation that we're in, we always want to take full advantage of all tax advantage accounts offered to us. Ordinary accounts, on the other hand, are accounts that are not part of any tax advantage plan. These are just taxable brokerage accounts that hold our investments. There are no tax deferments, and we will get taxed on our growth as well as our withdrawals. So how should we fit our 3-fund portfolio given these account options? Let's look at another general rule of thumb to help us. The idea of tax efficiency when it comes to specific investments. There are naturally investments that are already tax efficient to begin with. Most often, these are stocks and mutual funds that pay qualified dividends. Dividends that receive favorable tax treatments. And stocks and mutual funds that avoid paying out taxable capital gains distribution. Such distributions are common in actively managed funds that engage in frequent trading in their portfolios. Vanguard Total Stock Market Index Fund, the VTSAX, checks the box on both of these and is therefore a great example of an already tax-efficient investment. The dividend it pays are modest and mostly qualified. And because trading, the buying and selling in the fund is so rare, so too are taxable gains distributions. On the other hand, investments that are tax inefficient are those that pay interest, non-qualified dividends, and those that generate taxable gains distributions. Individual stocks, bonds, CDs, and REITs fall into this category. And because of their tax inefficiency, we would ideally like to keep them in tax advantage accounts that we talked about earlier, 401ks and IRAs. All right, now that we have a good understanding of the types of accounts out there and the concept of tax efficiency, let's take a few steps back and slot our 3-fund portfolio into this framework. As I mentioned earlier, Vanguard Total Stock Market Index Fund, the VTSAX, is already tax efficient. Therefore, if we need to, it can fit into an ordinary brokerage account. It doesn't mean it has to, but if we don't have any more tax advantage accounts remaining because we max them all out, then it is okay to hold them in ordinary brokerage accounts. And this is the same with Vanguard Total International Stock Market Index Fund, the VTIAX. The Total Bond Market Index Fund, the VVTLX, is not as tax efficient. Therefore, you want to prioritize placing it in a tax advantage account if you can. And of course, I want to reiterate, this concept only applies if you have already maxed out all your tax advantage accounts. And when it comes to filling your tax advantage accounts, the following will be my recommendation. First, fund your 401k plan to the full employer match. If your employer offers a 4% match, make sure to fund your 401k at the minimum of up to that 4%. This is essentially free money, and you do not want to leave this on the table. Second, fully fund your Roth IRA. Any money contributed to a Roth IRA grows tax-free, and you can withdraw tax-free when you turn 59 and a half. Max it out if you can. The contribution limit per individual in 2022 is $6,000. Third, if you have money left over, go back to your 401k and fund it to the max. Contributions to traditional 401k lowers your taxable income, and this is a no-brainer way to pay less in taxes. The contribution limit per individual in 2022 is $20,500. And only at this point, if you still have money left over, considering funding a taxable account. And this is where you can deploy the stock index fund and taxable versus bond index and tax advantage account strategy. Until you get to this point, I would recommend just funding your retirement account following your asset allocation. Alright, I covered a lot in this video, so let's do a quick recap. Step 1, we want to select our 3 total market index fund. For Vanguard, this will be VTSAX, VTIAX, and VBTLX. Step 2, we want to determine our ideal asset allocation based on our risk tolerance. Step 3, we want to identify the best type of accounts that is most tax advantageous to us. But most often this won't apply until we max out all of our tax advantage accounts first. A final note that I want to share is that though I advocate for Vanguard in this video, Fidelity and Charles Schwab are now offering great low-cost index funds as well. Of course, all spurred on by the low-cost bidding war that Vanguard started. If you already have a relationship with Fidelity or Charles Schwab, consider them to implement your 3-fund portfolio. Fidelity now even offers a 0% total market index fund, the Fidelity Zero Total Market Index Fund. So if you plan on staying with Fidelity for the rest of your life, it could be a great way to save a few dollars for investment funds. If you'd like to learn more about my 5 favorite Fidelity funds to buy and hold forever, check out my video here. Thank you guys for watching. Until next time, all the best.